Hello, everybody. And today we still have Patrick as our special guest, and he is going to talk about real estate investing in multifamily 2023. So, why don't
Hey,
we start?
hey, thanks for the intro.
You're welcome.
I think, basically, this year, I think we are looking into a very interesting year.
Okay.
Yeah, a very interesting year. We're going to see a lot of opportunity coming up.
All right.
Perfect time for people saving and looking for a bargain now.
Saving bargain now. Let me ask you, Patrick.
Yeah.
In Chinese philosophy, we talk about be water. This year, how can we be water?
Yeah, I mean that's a great point. I think everybody every year you should be like water. Where things are moving, you need to
Yes.
be dynamic. You need to move with the flow.
Be flexible.
Yeah, be flexible. And this year, it's a pretty good time. The people that's not flexible, they stick to one thing.
Yes.
They're going to crash and burn.
Okay, so why don't we talk about how we can be flexible in this 2023 housing market in multifamily real estate?
Okay, so the flexibility comes with the mindset.
Oh,
Yeah,
mindset.
it's all
Okay.
about the mind. So basically now is that whatever strategy you're doing, the fix and flip, the development and all those are the thing of the past is stuck, right?
Yes.
But what you're now looking at is that the opportunity comes in form of distressed properties, bargains, people that have to sell, and you're there to pick up deals, right?
Okay.
This is a fortune to be made when there's unfortunately there's blood on the street. It means there is fortune to be made.
I was talking to a very successful friend of mine. So he went back to China.
Yeah.
He has investments in hotels.
Yeah.
He has investments in golf courses. He has investments in land assembly and developments over here. He's probably worth 100 million, and his family's worth more. And I was just talking to him yesterday. We had dim sum.
Yeah.
And we're discussing what kind of investment we can do and what kind of investment we can make. How can we be profitable in the next decade? You know what one thing he told me was?
What is it?
He said that right now is not for you to go into hard assets. He told me that he almost bought a hotel in Shanghai.
Yes.
He put an offer in, there was subject on the property, and so happened in the end of 2021, COVID hit Shanghai. He didn't process the deal. He didn't remove subject. Had he removed subjects on the deal, he would have to put in a couple $1 million a month.
Yeah.
Into the hotel.
Right.
What he's saying is, Edward, doesn't matter what you do, don't get into hard assets right now. You want to focus on cash flow. If you want to get in, it's all about a cash flow game. You need money on the side. What he's profitable in doing, he never imagined. He owned a golf course that come with a hotel restaurant on the island. And he said that has been the most profitable investment in the past 5 years.
Yeah.
Asset value went up. His rooms for the hotel revenue keep on going up. Revenue for the golf course also keep going up.
So basically he is buying hard assets.
Yes.
And the timing you talk about was 2020, right?
Yes, before 2020.
Yeah, so right now, yes, that's right. So
he cash flowed.
Yeah.
So let me ask you this. For the people that are starting this business and for the people that have some assets,
yeah,
but not in that 100 million level, what are your recommendations?
So it's interesting because when it comes to real estate, there's many levels and each person's situation is different. All I could say is that if I am starting anew from now on, I'll be looking at finding distressed properties and I will find a couple investors to flip those deals on, because at the time, if you don't have enough capital, like you said, right, it's when it comes to real estate, it's a money scheme. Right, the more capital you have, the easier
it is.
Right, so what you do is you have to find partners that have the money. You line up the money and the deals and the people together.
Okay, so again, it goes back to the deal, the people, the money.
Yes.
What are you doing now?
What am I doing now is I'm actually approaching a couple of those wholesalers where they're looking for deals for me. I'm approaching all those realtors and I'm finding properties that's selling at discount, at good cash flow rate, 7% cap rate plus, and we're acquiring those properties.
Okay, so 7% cap rate plus. Let me ask you, what kind of properties are they? Where can you find them? And when you say deep discount, how deep are we talking about?
We have to negotiate. So all those is through negotiation. Right. Real estate, it's as much as it's an asset, but it's all controlled by people. So it's a people's game. Right? If the sellers have to sell, if the sellers motivated to sell, we're there to we're there to make the offer.
Okay, so you're talking about that we have to find distressed sellers for the audience who want to make money this year in the real estate multifamily game.
Yeah.
First of all, you find the distressed sellers that are willing to give you a deep discount. I want a percentage.
And also cash flow.
Right. So let's focus on the deep discount.
Yeah.
Because let's say if you have a place for $10 million, it's not possible to buy it for $1 million, right? Nobody's going to sell for $1 million.
Well,
the equity is more than that. So what do you consider is a reasonable discount?
Well, I'm happy with a 7+ cap. To say it very honestly, why? Okay, let me explain. The 7% cap means that your money is working at 7%. Either you borrow the money from the bank, you borrow money perhaps now at 6% or so, right? So you're still going to end up with a positive return. That's what I mean. So that the discount comes from exactly what your friend is talking about, the cash flow.
Yes.
Right. So you're focusing on the cash flow of the deal.
Okay. So now if we zoom in on the cash flow side, for 7%, remember we went to Edmonton. We looked at 10 properties there. And some back then, 2021, the end of the year, some properties were 5% cap rate. Some were close to 6% cap rate.
Yeah, that's correct. Yeah.
Obviously, the nicer the property, the better the area. Let's say the one that we went to is by university. It's nice, it's beautiful. The quality of people there are wonderful. You get lesser cap rate, a lesser cap rate. So let me ask you this. If you can be water and you can find those, identify the right properties, what would be your margin safety and what would be the cap rate that you'd be looking for?
Yeah, so it's all come down to what you can negotiate. At the end of the day, now it's a market to negotiate. Your margin of safety, it's about comparing to other properties there. If you could get a 7% where other people are paying about a 5.5% or 5% for their cap, then you already have a huge margin of safety. So now that's extremely hard to do.
That's like a 40% increase.
And it all boils down to the work and all boils down to the deal, right? If you don't have deals like that, very simply, you don't go ahead, you don't move forward, you just sit and wait until the market comes to the right time.
So in that case, so let's talk about you. So in your market, we talked about whichever top 10 market in Canada is.
Yes.
What is the current cap rate in those markets?
Current cap rates that a lot of people are looking at, we see deals about 5-6%. They're trying to hold on to it now.
So 5 to 6% cap rate.
But we do have undisclosed pocket deals that's doing 10% or better.
Okay. Let's say if you find a 7% cap rate deal where the average market price is 5 to 6%, would you go for it? Would you go for a 1% margin of safety?
It's not a 1% margin of safety, just in relative terms.
Relative terms.
Yeah.
Usually one as a margin of safety.
So they might be selling under market price for like 10-15%, when they were initially. So of course there's a lot more factors to be involved with the deal, right? So we will have to go, and that's where we start our due diligence. We start our work and we start checking out all the numbers and stuff and making sure it's
Got it. Okay, so now we talked about the specific deals in the multifamily. Now, let's talk about the overall. What do you see in 2023?
I see that, I'm seeing that the Fed might have to pivot a certain time because they're getting a lot of pressure now, right? So interest rate would be, we've seen inflation already topped, okay? It was, last report came in about 6.5% inflation.
So getting controlled.
Yeah, so it's getting controlled, but not as much as they liked, right? I see that if it's not managed well, oil price would be again being another uptrend, right? So it's really hard. This market is really hard. The only way is just go out there and find and work good deals. That's it. They just keep your risk low, work good deals, make sure you have cash on hand.
Okay, so you're telling us very conflicting things. Number one, find deals.
Yes.
Number two, if they can keep the inflation down.
Yeah.
Number three,
Interest rate will come down.
right, interest rate. So
Yeah, interest rate is coming down because of pressure on the Fed.
pressure on the Fed.
Yeah.
Okay, so that this year the interest rates come down. You're saying that we already reach a height, and they're not going to be raising the interest rate anymore. It flattened out.
Yeah. Basically, right now it's like look at the market. They already see we already had hit a high
Mm-hmm.
of back then what was it like
Like 5
9%, inflation.
inflation.
Yeah, it was at that high.
Yeah.
Now it came down to 6.5, right? So now it's just a matter of time before the Fed has to
adjust.
had to adjust the rates, and that's what a lot of the market's feeling it. Of course, we're not there to speculate just on rates, so that's why we want a margin of safety, right? What we focus on is just picking up deals that's discounted, distressed, and then we will acquire those deals with our capital.
Right. So you have the cash ready on the side.
Yeah.
And you're gonna go in and acquire whatever capitals whenever you see a good deal coming up.
Exactly.
How long should you wait? But once they do come down, then all of a sudden you have a flood of capital going to the market trying to pick whatever that's on the market.
Yeah.
Should you, if you find a good deal now, should you pull the trigger?
Absolutely. So a lot of times is that even nobody gets the market timing correct, right? You just want to see what makes sense, and then you just go do it. So it all comes down to the deal specifically.
Okay.
Yeah.
Got it. So that's the 2023 housing market. What are your strategies in operating these multifamilies?
Oh, the thing with multifamily owners compared to single family houses is that with multifamily, they're more toward the market. So when it comes to discounting, a lot of times they're lagging behind single family houses.
Yeah.
So the trend is the single family house will move first, then multifamily because they have a stable income and stuff. They're not as market sensitive.
Okay, so another thing this came up is I read a lot of newspaper and reports saying that 2023 there's 98% chance of having a recession.
Yeah.
And usually that is not good for the real estate market,
No.
multifamily, that's not good for the rates. So let me ask you, going back to the question, if somebody has cash ready on the side, should they be pulling the trigger this year or should they be pulling the trigger next year?
Well, it all comes down to this, right? Investors, we're just thinking, okay, we're just looking at this very similar thing. Where can we put our cash to generate yields, right? So as an investor, if I put my cash in the bank now, I get about 4.85% with a high interest rate savings. But if I put myself into those real estate deals generating, 6, 7 cap above, then I'm actually yielding a much better return compared to the money in the bank. So that's very practical way I would look and compare interest rates and where you're getting value of your money.
Okay, so I think at this point it's pretty clear that 2023 you find good deals, you put money on the side. But to be quite honest with you, everybody will give you the same advice.
Yeah.
Okay, so is there a different advice that you will give?
So the advice doesn't apply to everybody, right? If you don't have that much capital, right, there's a different strategy you do, right? You might have to flip deals, you might do wholesales, you might do other things to make money in real estate, right? Because the main point of this podcast is how I would do to make money in real estate, right? So if you have capital or you have a network of investors, then you want to buy and hold.
Okay, so let's go to that. I know that you're raising some capital right now.
Yes.
So what are your goals this year in regard to how much capital you're raising? How many deals are you going to be buying? Do you have any solid goals?
Yeah.
So what are they?
Right now, we're raising about $5 million in total. Right, that's kind of my target for this year.
So with $5 million,
and I plan to pay about $120,000 per unit.
Okay, $120,000 per unit. So, but the $5 million, you're raising cash, and you can leverage.
You can leverage.
So you're going to be looking at purchasing, let's say, a $30 to $40 million portfolio.
Right now, because of the bank and the financing, you could probably do a 50-50 split, about 50 down, 50% down, 50% for the.
Oh, so so the leverage is about 50% right now.
Yes,
So
that's right.
your goal this year is to purchase $10 million of assets
Yeah,
through raising $5 million
yeah,
at $100,000 to $120,000 per unit. That's
yes,
what your goal is.
yes,
Okay. We'll see how that works.
yeah.
So
we'll
what
see.
have you done so far?
Right now, I'm just working on it. I'm
Yeah.
just putting things together, putting some paperwork together, reaching out to my investors. At the same time, going through deals. That's it.
Okay.
So there's a deal side, there's a money side.
Right. Would you like to expand on what your strategy is to get to your goal this year?
Yeah, my strategy is just increase the amount of leads coming into my system on the deal side.
So how are you going to do that?
Approaching more realtors, giving the message out, approaching more people, letting people know we're there to pick up deals.
So let's say if your goal is to find 100 of these multifamily units
Yes.
for $10 million. Okay. How many deals do you have to look at to get there?
There's no fixed number because a deal could be 50 units or a deal could be 10 units, right?
Right.
So that's completely dependent on the deal, right? That's completely dependent on the deal.
Right.
Of course, if maybe it's too small, then you won't look at it.
You won't have scale, for example,
you
right?
won't have scale.
Because I know that the average multifamily unit that you're getting is from minimum 20, 25 units all the way up to 100 units.
Yeah.
If you can get one building that's $10 million, that gives you a healthy return, you'll probably get that. But my question for you is there a number of deals? How many deals do you have to go through in order to secure this one deal?
Right. Hopefully as few as possible, but reality ideally we probably have to go through like, maybe a couple hundred deals.
To find one deal?
Yeah, so really depends.
So again, it's like that funnel system that we talked about,
yeah.
Right? You have the traffic system. It's like, let's say you look at 100 deals, you put offers in for 5 to 10,
yeah.
You probably get one deal on their contract and you go through your due diligence.
Yes.
And at the end of the due diligence, there's 20-30% chance you might not even remove subject on that deal because there could be something that will come up.
Another thing I would like to add is the opportunity that I see for the beginning investors or even the advanced investors, right, with not too much capital, is that there's more and more now. For you cannot do, nobody in the market would do vendors take back deals. Now we're seeing more vendors take back deals.
That's something interesting. Can you expand on that?
So with the vendors take back deal, I've done a couple of them before. I could put very little money down, let's say for like, 10, 20,000, whatever, very tiny, and I could control an asset that's 10 to 15 times over. And it depends on the way you structure the deal.
This is the maximum leverage that we were discussing before, how there are forces that amplify our money.
Yes.
It goes both ways, though. It's a double-edged sword.
Both ways.
If the market improves, if the market gets better, rate goes down from the feds, then you make equity. However, the other way could be true.
Yeah.
You could be overextending yourself, not enough money in an asset, and therefore the lender can recall your loan.
And let me drill down a little bit about the thing, right? With this, the good thing about vendors take back deal is that the interest rate are not like the bank, because the seller are motivated to sell you the property.
So they're going to take a lesser interest rate.
So you could actually, and it's completely, because it's deal by deal, complete by the person, by the way that you put deals together. You could actually negotiate deals that way below the market the interest rate too. So it's totally up to you to the deal.
This year, what would you say is a typical rate that you can get? Number one. Number two is, let's say out of $10 million, just keep it simple. How much can you borrow from the seller?
And like I said, those are completely up to the seller. If the seller is super motivated to sell, you could give them 5% down, 10% down.
And they will just give you the whole thing.
Yeah, and some even like, hey, just take the whole thing, right? So you might get lucky that way. And it's completely, not up to your eye to say, but up to the deal you have on the table. When it comes to the bank, right, the prime rate for the bank, you're looking at commercial rates about 6%. Roughly, if you're dealing with the bank.
How about this? To keep things easier, is there a deal that, let's say, without disclosing the location, place, maybe some numbers? Talk about the process of how you structure that. That kind of stimulates your appetite
Not that stimulating,
I'm-
but okay, I am
then your tolerance is very high now.
right. Okay, so I have a multifamily deal doing 6 cap commercial building.
Okay.
They were asking about 2.7. Now they were willing to come back to 2.2.
2.2.
Okay, so that's one deal
So
I
a
have.
2.2 is
Yeah.
6 cap, or a 2.7.
No,
6
at
cap.
that time it's already
6
7
cap,
cap. So
7
we're
cap.
doing 7 something now.
So
right? Closer to 8.
that's like a 600,000. Yeah, that's
Yeah.
closer to 8.
Okay, so that's one deal we have here. A
Right.
very
Can
nice.
you give me
building.
some details about that? Like,
No, that's it. That's
no, I mean not the address. I mean the state of the building, the operations, how many units.
The building is very
Yeah.
clean in a very nice city, very nice neighborhood in the city. It's very stable. That's one deal.
So can we just focus on that deal? What do you like about that deal?
Oh, overall, like I like the clean building. I like the stable revenue. I like the tenant base on the building. There's some A-class tenants.
A-class. When you say A-class, what do you mean by that?
So things
they
like Shoppers, Drug Mart.
Oh, employees,
Yeah.
or are they
no, the
executives?
retail.
Oh, so it's a commercial.
Yeah, commercial.
You don't have to talk about the location.
Yeah.
Okay, I don't want people to go after the deals. I just want the audience to know what they should be looking for.
Yeah.
Because everything we're talking about right now, it's all very broad.
Yeah.
I just want to nail down on something that the audience can take action on, right?
Right.
So you like the fact that it's a commercial building. You like the fact that there's potentials for high cap rate from let's say a 6 to an 8 now. There's potentials also for
no, it's already at selling.
Oh, it's already at 8 right now. Okay. So you might pull the trigger when it's at 8. Okay, got it. So what do you not like about this deal?
Well, I don't like it because commercial on a recession might take a certain amount of risk, right? Because we have but in that city, I find it's going to be fine, right? So you have to be cautious, right? Because commercial, sometimes the office space takes a hit during recession.
During recession time because nobody's working anymore. But you just said that there's a shopping plaza with AAA clients.
Yeah.
So isn't that somewhat recession proof?
Somewhat, but you still have to be cautious because what happens when you buy the whole building, you don't only have one or two.
Right.
We have multiple tenants, right? And you have to look at the percentage and there's retail space, there's office space in the building.
Then now we're getting into the commercial property management space, retail management, and you're making rent off that.
Yes.
Okay, so
and once it's stable, it is stabilized now. It should be pretty fine,
Okay. Yeah. Okay, so that's one of the deal you're looking at.
Yeah, right? Another deal that I think might
is there a more interesting deal
on the audience that don't have too much capital is that we are seeing some deals that houses that's selling for $350 now could actually own them by putting only $20,000 down, right? So that's a good leverage ratio.
So a $20,000 down for a $350,000 house?
Exactly.
Are they cash flowing?
So that you will have to work with the interest rate, right? With the thing, and it's all up to negotiation.
Yeah, can you give me some details on the deal? You don't have to talk about where it is because I know you see a lot of deals, but I'm just asking. Give me some details. So you can put 20%. You can put $20,000 down to secure a $350,000 deal.
Asset. Yeah,
that's less
and
than
completely like if you're playing like those
8%.
type of things, right? It depends on what you're paying for, right? So at that time, I would be happy when the property actually breaks even because basically you're getting a lot of good leverage. You negotiate yourself a good loan term, right? The term of the loan makes sense, right? And you have a tenant in place in a decent area. So that itself is a good deal because what you're looking at is that you're looking at a fixed loan, fixed interest, and a solid revenue stream, but you own an asset, right? So a lot of times where people get rich is that using leverage is using a small amount of capital to control a big asset. That is one way people could, benefit off the upside of the real estate.
And that's the real estate game because real estate is all about leverage. That's how you can make money in it. Whereas all the other assets like equity, securities, you're not using that much leverage.
Yeah. So it's partly business. Real estate is partly business and partly an investment.
Yeah. And obviously that is only under the assumption that you're in a market where you think is the lowest point, and there's following years more money to be made, and there's more appreciation in the asset, price go up by 10%,
Well,
for example.
yeah, I will add to it, right? So if you, let's say, if you negotiate a deal on that thing, right? Let's say it costs you a thousand, $1,500, right, a month in maintaining the property, right? You put $20,000 down, 1,500 to maintain it, but your rent come in is at about the same, 1,500. So you kind of break even within the deal itself,
Right.
even though, and you get yourself into a 3 to 4 years term, right? Even though next year the market continued going down, they did not lower interest rate, blah blah, market still down, you still ahead of it because you're getting the deal. You mean you have the asset under control, and what happened is because your numbers are not losing, the cash flow, the net income and your expense is breaking even, but you're still controlling that asset. So it's about the term of the deal that's also important too. So if you get yourself a 4-year term and your market drop for the next year and the next year, but on the third year it recovered, you're still gonna benefit of those deals.
That's if you secure your financing.
So and that's where it comes to negotiation.
So it keeps coming up because you keep on talking about the negotiation, the deal itself, and it's very subjective.
Yeah, it's very subjective.
So
it's not like the stock market. You buy it at this price and that.
No, like what I'm trying to say is that if we're being very subjective, it'd be hard for our audience to duplicate what we're doing.
Of course, you can. That's the whole point.
But that's the whole point of this show, is so that you can share something with the audience, so they can duplicate, they can model.
The best way to duplicate is that being in the industry and just actively doing deals nonstop, like just being in the game. You know what I mean? So you could read so many books, you could take so many courses, but at the end of the game, just like a realtor, right? How you sell a house. I think at the end of the day, it depends on client, depends on the house, depends on so many factors.
So if I were to talk about being a realtor, whoever is starting in real estate today, my advice, I give an advice to the company. New realtors coming in, they said, which niche should I be in? I list out every single niche in real estate. I said there's commercial, residential. You have to figure that out first. What do you want to be?
Exactly.
And within residential, there's the demographic. For example, you have the west side, east side of the city. You have multiple demographic, geographic. You also have different products. You have pre-sales. You have townhouses. You have roaming houses. You have single family houses with big land. You have luxury houses. So what do you want to do? I asked them. So one of the guys that came to me for advice, again, I'm not a realtor. I'm not selling anything. And I told him, I said, what are you interested in? Commercial real estate. I say, which part? Is it multifamily, or is it development, land assembly, retail, hotels, industrial? So I looked it up. He did his research and he found that he's interested in land assembly for a development site. Okay, well, do you want a big development site or small development site? Okay, so a medium to small developer. So we niched down. So now he knows what to do. Then he said, how can I start? I said, well, then you go and door knock. You go knock 100 properties. You go and read the city document. See what's on the rezone, what's coming up in the next 3 to 5 years. You read the transportation plan. You see where the city is going. That's where the market is, right? You see where the trend is in the city. So he did his homework every single day. He read newspaper reports, city reports, commercial reports on a daily basis. Now he has knowledge. He knows where to start. It's not general anymore. It's not broad anymore, right? He niched down. He figured out a specific market that he's going to go and dominate. Then he studied all the top players in that marketplace. He found that there's only a select few real estate teams that are doing land assembly. Great. Copy them. See what are they selling? What are they not selling? Where can you find your niche? So
same deal.
He asked me for advice. He's like, okay, how do I know the price square foot of this site?
Do your market research.
So it's easy for you to say, market research. But again, that's very broad.
Right.
When you talk about very broad things, people imagine they don't know how to do it.
Right.
What you have to do is put it into very actionable terms. So I told him this. I said, look, if you look at Collier's report, JLL reports, they will have price per square foot. They will have every single city, how much you can lease a warehouse for example. maybe in one city is $12 a square feet, and another
Yeah.
city is like $15 a square feet. Every quarter they have these reports. That's how you get your pricing.
So what you want to say, it's like
So
look at the CMHC report. Basically,
exactly.
that's the same
So
thing.
let me ask you this.
Yeah.
If somebody, because again,
But we're
I'm-
talking about negotiating deals, right?
yes, but when you're negotiating deals as well, you have to know what the number you're dealing with is.
You're looking
have to
at
have-
the interest
so-
rate, so you know the interest rate.
First of
Everybody
all,
knows that.
before you go into negotiation,
Yeah.
all right, I'm an expert in negotiating over $400 million in real estate
Yeah.
transactions
Yeah.
for my clients. Okay.
Yeah.
You start off with a purpose,
Yes.
with a goal. First of all, I want to buy this luxury house. What's my goal right here?
Right.
Maybe to list it for $10 million. My highest that I'm willing to do is 9.8 million because I really like this property. That's it. You don't go over that.
So price.
So let me ask you this. In negotiation, you have to know the product,
So
know the price.
in real estate negotiation, we have price, we have terms, right? In this case, we're talking about terms because a lot of times price we already kind of came to. Like term is the one that say, hey, you know the interest rate
Yes.
at this, you do your reverse calculation. Okay, if at 4% it costs you, like I said, $1,500, right? Then you do the deal. You ask them, hey, are you accepting 4%? If you say yes, then you have a deal. So that's it.
So I guess my question for you is how. So when you say it's like, okay, you need let's say the market is like 5%, you can get it for 7%. It's a pretty good deal.
Yeah.
That's
so
what
I'm talking
right?
about the term of the vendor's take back. Okay. So you were talking with the thing how you negotiate deal with the seller. Okay. So let's say I want to buy your property, right, for $350,000. Okay, fine, price is fine, but I want it at 4% instead of the market rate at 6%. Would you willing to do it? If you're willing to do it, then we could have a deal. That's it.
And then if not, then you move on to another deal.
Same as what you do.
Then you move on to the third deal, fourth deal,
exactly.
fifth
So
deal.
it's work. It is exactly.
So for somebody who's starting, let's say if they don't have any multifamily, they want to get into multifamily. What do you recommend? Where should they start?
Exactly how you recommend it. You go out there and you do it. Then you go and you
is there any like specific thing that you can tell the audience?
Well, you have to pick a city. You do a market research. You pick a city like I mentioned initially on my first interview.
I think the easiest way, I want to answer that question for you.
Yeah.
The easiest way, you go on MLS online, you look up multifamily real estate. You see what type of buildings there are, what area, what location. You can go online, you find 2 websites, and you look at 100 properties.
Yeah, just go look at.
You look at 10 a day, in 10 days. You look at how many units there are, who's selling it, what kind of price are you going to be looking at. If you can get sold information, that's even better. You know what the sold price is. You also want to figure out what's the tax, what's your expenses. You want to work out some numbers. You also want to know the story of the building. Why are they selling? What else should you know when you're looking for samples like that?
I mean, that's basically you mentioned it. So.
Okay, so you look at all of this. So that's a pretty good actionable plan, right?
Yeah.
Okay, so in this case, let's just sum everything up. In 2020, what Patrick is saying, the market is going to be stabilizing and coming back up again. There's going to be foreclosures, good deals, have cash ready on the side so you can go and find a good deal. And the way to identify a good deal is, let's say if the cash flow is at 5% cap.
So I'm saying the market could be stabilizing. So nobody knows what the market is, but the game plan, right? So there's a strategy part. There's what the market's doing, right? Nobody control what the market does, but there's what you could do if you want to flow like water, like what we talked about. You come up with strategy to tackle the market condition. The market condition now offer a lot of opportunity on negotiation and distressed properties, right? So that's where I see you could come in to extract value on this current market.
So you focus on distressed properties, you're trying to say?
Negotiation and distressed properties would be the opportunity this year.
So again, your focus is to negotiate distressed properties.
Yeah, it could be distressed properties, or it could be, any motivated. I think it's better to just say motivated sellers.
Okay, to be quite frank with you, anybody in the business knows that any market, you want to find the motivated sellers in every single market.
But this market is what you focus on specifically, and you have a much better chance. If it's on the market a couple of years ago, you don't have a chance. there's not that much. Let's be honest, there's not that much motivated
Yeah, there's
sellers.
not.
It was just a dream. Now it's a reality.
So now you're trying to say there's more
Yeah, there was no
motivated.
vendors take back.
Okay.
When the market's hot, there's none motivated sellers. There's none of that. But this year, you actually could.
Okay, so this year, when you're dealing with motivated arcade sellers and you're looking for these deals, you have to be cash flow ready. You have cash on the side, and you can start using different tactics like vendor takebacks, huge long terms of closing. You can put in multiple offers in multiple properties at once, whereas before you can only put one offer on one property because there's not so many of them around.
Yes.
So that's your strategy this year.
Yes,
that's ace in the game.
That's
right?
a strategy to capture.
Okay, I think that's something that we have really good so far. Okay, so is there anything that you want to tell to the audience?
That's about it.
That's about it?
Yeah.
Okay, cool. That sounds good. So let's end the podcast. Thank you for watching, and we'll be back with something good next week again.
Thank you.
Bye.